Welcome to the Wealth Studying Podcast. This is episode 459. Today is December 15th, 2024. I'm your host, John Pugliano. I'm also the founder and money manager at investablewealth.com. Well, today I want to talk to you about what's going on in the markets in general. And what we'll cover is that the markets have come to the realization that inflation has not been tamed. In fact, it's what I would consider significantly higher than what the pundits have been telling us it's going to be, but nothing we should be surprised about. I want to cover that. And then I'll also prognosticate a little bit about where the markets may end the year and how I see things setting up, especially into the first half of next year. Hey, before we get to all that though, and actually this harmonizes a little bit with what we're going to talk about today, I do want to mention that about a week or so ago, I was on the Disciplined Investor podcast. I was talking to my friend Andrew Horowitz. We had a really lively and good discussion about automation and its impact on the economy right now. But the main part of our conversation that I think was really the most informative was when we started talking about the long-term trends that are in place right now and how President Trump's policies may interact with those trends. And specifically, I compared the Trump 2.0 presidency with that of a previous president, and all that might surprise you. So I'll put a link in today's show notes. Check that episode out over at the Disciplined Investor podcast, and then come on back to me with any kind of questions that you might have about what I say there, and if need be, we'll cover those topics here on my podcast directly as well. Hey, what about inflation? This upcoming week, the Federal Reserve is almost 100% guaranteed to cut rates another 25 basis points. That'll be 3 cuts for the year. If you remember going back this time last year, a lot of people in the market were so exercised about inflation being defeated that they thought we would have as many as 6. I was extremely skeptical of that. That actually kept me out of the market for most of the first quarter of this year because I thought that irrational enthusiasm about rate cuts that were never going to materialize would have at least a short-term pullback in the market. Ends up that never did happen. But we haven't got the rate cuts a lot of people were expecting, and that's simply because inflation has not been tamed. Inflation is not anywhere near the Fed's target rate of 2%. This last week, some more data came out. I think this past week it was the CPI. All this is really mumbo jumbo, whether it's CPI, PPI, this or that, Fed's preferred rates. The bottom line is no matter how you measure it, inflation is not only significantly higher than the Fed's target, it's significantly higher than the trend that we've been on for the last 20 years, and it's not going to normalize back to that old trend line. I believe we're in a totally different interest rate and inflation regime from what most people have been used to, and they just haven't come to terms with that yet. No matter how you slice the data, the inflation rate is somewhere around 3.3, 3.6, let's just call it 3.5% year on year. The Fed's target is 2. On a percentage point basis, that doesn't sound like much, but it has a significant impact on higher prices going forward. If you break down those numbers, they could be even worse than what they're talking about because that 3.5% is what we're referring to as core inflation. But food prices are back above that level. Overall, food came in at 4% year over year, and if you're someone that eats like I do, then you know that it's really going up a lot more than that, especially for those of you that eat out at restaurants. When you break those numbers down a little farther, you see that farm-produced products, so we're talking unprocessed foods, they were up over 6%. That has a lot to do with weather patterns and other problems, but again, these are trends that the Federal Reserve monkeying around with rates aren't going to impact. So food prices from the farm going up in excess of 6%. Processed foods, they went up about 3.5% year over year. Oh, and let me digress here a second. As far as those farm-produced products, if you think 6% is high, wait until you see what's likely to happen to beef prices. There's major problems with the herds there. But wait, it gets worse. Other commodities are up significantly more than even food. What I found interesting is even though we're not really back into any type of a residential house buildup, lumber prices have really jumped over the past year. This past week, that number came in at over 9% on year-over-year lumber prices. Now, obviously, they did settle down from the craziness they got into at the peak post-pandemic, but still 9% year-over-year. If you have a construction project, that's taking a major bite out of your budget. And then as far as metals, what really caught my eye was non-ferrous metals up over 10% year-over-year. Oh yeah, and then that other category of just generally miscellaneous commodities, those all up at least 6%. And because the Fed's monetary policy still doesn't have a good handle on rising inflation and on these spikes in commodity prices, we're continuing to see workers demand higher wages. And so again, year over year, the cost of labor has gone up significantly. And in the report that came out last week, it said over 4% year over year. And that really gets back to the demographic issue that the baby boomers are leaving the workforce in droves, and automation hasn't yet caught up enough to offset that disparity in the workforce. That's not something that's going to happen overnight either. So expect labor costs to continue to go up. Now, I don't have the housing number in front of me, but I know that also came in a lot higher than the quote experts were expecting. And really, when you add those two together, when you add increasing housing prices and increasing labor costs, that's just a upward spiral that continues to drive inflation higher. And again, nothing I see in the Federal Reserve's policies of whether they lower or raise rates are going to impact those long-term trends that are impacting wages and housing costs. And while so many people in the financial media are, surprised that inflation isn't tamed, I again come back and question why anybody this time last year was thinking that we would have as many as 6 rate cuts in 2024. And I further question the Fed's policy of why they even cut rates, just a month ago ahead of the presidential election. Oh, wait a minute. Yeah, the presidential election. Okay, yeah, I get it. Okay, never mind. Forget that question. In any case, we are in a different interest rate and inflationary environment than what we've seen the last 20 years, especially the environment that we saw post-Great Housing Crisis, Great Financial Crisis of 2008. And for people that keep waiting for mortgage rates to go back down below, pick the number, 3.5%, 3%, I just don't think that's going to happen anytime soon, if ever again. Now, ever's a long time, but where the current mortgage rates are right now isn't necessarily out of line. It really comes back to where the 10-year Treasury is going to finally settle in. And I actually think the 10-year Treasury is not high enough. When you factor in where the debt and the deficit are, and the fact that we do have this aging population, which is going to drive up labor costs regardless, and then you also factor in the geopolitical issues and the realization that Cold War II has already begun, and then you look at all the malinvestments that have been made over the last decade or more, and especially all the, quote, transitions that money has been thrown into needlessly. By the way, look at Europe and specifically Germany's economy right now, if you don't know what I mean. You factor all that in, and all the opportunity and money that's been wasted because the cost of money was so cheap for so long. And cheap, by that I mean the Federal Reserve had suppressed interest rates for a good, maybe not entirely 15 years, but definitely more than a decade. They kept rates lower than they should have been. That created so much malinvestment that when you look at the Russell 2000, the small cap stocks, we're still, even with the booming economy we apparently have right now, you still have somewhere in the neighborhood of close to 40% of small cap publicly traded companies are not profitable. These are zombie companies that shouldn't be in business, let alone shouldn't be publicly traded companies. This is a concern that I have about a lot of the enthusiasm we see in the stock market. Don't get me wrong, I still think things are going to be well next year, and I'm positioned, to be fully invested for next year. But I'm picking and choosing what companies I invest in with great forethought. These zombie companies can't be kept on life support forever. And one of the main reasons is that we are no longer going to have those artificially suppressed interest rates that made money so cheap. You hear about all the concern about the high levels of interest payments that the federal government has to pay. Well, that's also true of all these other small companies that borrowed money that, unlike the government, can't just print it out of thin air. So I think the day of reckoning is coming for those companies. But I digress. Anyways, the 10-year Treasury, I think, is too low, but you could still make the argument that it's at least directionally where it should be, a lot better than where it's been over the last 15 to 20 years. As a rule of thumb from economic fundamentals, and this just makes sense when you think about it, the 10-year Treasury should be somewhat related to nominal GDP growth. Meaning that if you're going to lend your money out for long term, for a 10-year period, you want to get a rate of return on that which compensates you for risking your money and not having access to it for a decade. And so you would expect the yield that you would get on the 10-year loaning out of your money to be growing at a rate somewhat similar to the economy, right? And we're not talking about the GDP that they talk about in the headlines, because that's real GDP. They subtract inflation out of that number. So we're talking about nominal GDP, which means measuring the economy in its actual nominal dollars, not inflation adjusted dollars. When you crunch those numbers, let's just assume the economy is growing at 2%. They're telling us it's growing higher than that. And let's just assume inflation's 3%. We know it's a lot higher than that. You add those two together, that's 5%. That's nominal GDP growth. If you're loaning your money out long term, you want to be paid compensation of at least 5% yield on that money. Well, the 10-year Treasury right now is sitting, somewhere around 4.25. I'm telling you, it should be closer to 5. And so, no, I don't think we're going to hit a target inflationary rate of 2% or whatever the Federal Reserve wants to come up with anytime soon, because they continue to talk about cutting rates and wanting lower rates, even though rates shouldn't be going any lower and perhaps should be going higher. But you know what? Suddenly, after the election, the Federal Reserve has changed their tune on raising rates. And like I say, all of a sudden, they're getting very hawkish and talking about maybe only 1 or 2 cuts for next year. And maybe they really didn't have to juice the market and cut by 50 basis points just prior to the election. In any case, the market's not happy about that. And although the Mag 7 and the S&P, still seems to be getting held up with the enthusiasm around tech stocks, and a lot of the meme stocks have come back, and obviously crypto and Bitcoin are all going through the roof. But if you look at the underlying market conditions, I'm much less optimistic today than I was a month ago. And that's because right now, we're not seeing a broadening out of the general stock market. Yeah, again, those handful of big companies are still doing very well, and you can pick selective stocks that have really done well since the election. But that broad-based movement, the only stuff on the bottom that's really come up is the banking sector. And to me, that's not a good sign. Earlier this year, when we saw a broadening out of the markets, we saw a groundswell of companies with improving earnings and correspondingly improving stock prices, and that was across the board, among 3,000-4,000 stocks. It wasn't just the financial sector or just the tech sector. So that concerns me. I think a lot of this has to do with, again, the fact that the realization that inflation isn't going back to that Fed's target anytime soon, inflation hasn't been tamed, and interest rate cuts are going to be severely curtailed. So as far as these last couple weeks before the year's out, are we going to have another big burst of money come into the market and a traditional Santa Claus rally? Well, maybe. From a seasonality standpoint, it still makes sense because there's a lot of money that comes into this market this time of year because of the settling of corporate events like purchase buybacks and reinvestments and things of that nature. So traditionally, we do get that Santa Claus rally. It came really early this year, though, with all the enthusiasm from when Trump got elected. And so I'm less optimistic now that we are going to get a strong finish to the end of the year, because I think it's already taken place. And we'll see what the Federal Reserve says with their open market meeting next week, and if they come out extremely hawkish, are really talking down the fact that they have a handle on inflation, then I actually think you could see the market close lower from where we are right now. And it gets worse from there when you consider geopolitical issues. Just since we've had our last episode, the government of Syria has fallen. We really don't know what that's going to mean in terms of the power struggle and shift in the Middle East. It looks like Iran is going to become a lot weaker, but of course, when a country becomes weak, it causes them to lash out. That could create problems. We definitely have Turkey rising in political power in that region. Israel continues to be very aggressive with defending and, expanding military actions around their borders. And obviously, when you turn to Europe, both the Ukrainians and the Russians trying to gain as much land and territory as they can ahead of what might or might not be some type of a peace negotiation. We know that Biden has authorized long-range missiles to be used, which could really disrupt not only the Russian economy, but specifically their fuel sources and international prices for gasoline. So that could really disrupt international oil prices between, the end of the year and early next year. And what I've talked about to this point is, just been about military issues in Europe. But look what's happening with the European Union, specifically the governments and the economies of the big leaders there, Germany and France. I don't have time to go into all the issues now, but if you're paying attention to the news, the major economies of the European Union are at a distress point. And a lot of pontificators are saying, hey, look how cheap European stocks are. Well, again, they could be cheap for a reason. And it isn't that I wouldn't commit any money to investing outside the United States. I do like buying dips, and I potentially, could even maneuver into some ETFs that I would use to expose just a small percent of an overall portfolio to markets outside the U.S., just to be a contrarian and to buy that dip. But at the same time, all these trends continue to point to the fact that the very best emerging market in the world is the United States industrial complex. Now, we'll get to that in a second. Before I go there, one other thing that can, again, disrupt the Santa Claus rally and definitely mess up the market early into next year, and that's the East Coast port worker longshoreman strike. Remember, that never got resolved. It conveniently got postponed until after the election. I think that comes up on January 15th. Trump has already come out and said that he doesn't support further automation and he's trying to protect union worker jobs. So maybe that'll protect the overall economy from a major shutdown of imports and exports. There could be significant economic repercussions if those ports shut down. So watch for that. Okay, that's enough of all the bad news. What about the glass being half full? Well, on the good news side, despite all the negativity I just spouted, I actually do intend to buy more stocks between now and the end of the year, and likely will again readjust my portfolio early into next year, and I'm talking within those first 1 or 2 weeks of the year. But overall, unless things change, my plan for 2025 is to be fully invested, but invested very selectively. I do think that we are in a stock picking market, and I would issue a caution to people that are simply buying the index, especially buying the S&P 500 on a capital weighted basis, which is how most of the S&P 500 indexes are. I'd be very concerned about those high-flying tech stocks, and specifically a lot of the Magnificent Seven, and then that S&P 500 in general, which has benefited from that in terms of having a lot of multiple expansion, but not corresponding profit growth. So it's a long way of saying I think that the cap-weighted S&P 500 is overpriced. But again, not the general market. Below that, I think there are incredible opportunities. And it gets back to those long-term trends. In fact, these are not only long-term trends, we're seeing generational shifts. Things that only come about every 25 to 50 years. The demographic shift with the boomers retiring. The geopolitical shift with the political instability around the globe as we have a reshuffling of military spheres of influence. Whether it's a Cold War II or whether it's a hot peace, we are not in the same geopolitical stability that we had been in over the previous 30 years. And then also that technological revolution, it's real. Artificial intelligence, large language models, robotics, automation, it's all just digitization of the economy. It's been happening for over 70 years, but it doesn't happen all at once. We had the computer revolution when it came in. Then we had the internet revolution when it came in. Then we had the move to internet over mobile devices. Now we're in this artificial intelligence aspect of the revolution. Each one magnifies and builds on the previous advancements. And it's that every 15, 20, 25 years or so, they all align up at once. That's what we saw happen in the late 90s. Computers had been around for a long time at that point, but digitization couldn't fully be maximized because we didn't have the information superhighway. But that's when the internet came in. And so that created a major generational technological change. It occurred in the late 90s. Incidentally, that was related to geopolitical issues because remember, it was about a decade before that, or within that decade, the early part of that decade, that the Soviet Union fell apart. And so all that technology that was tied up by the military over the period of the next 5 to 10 years was released for civilians to use. So a lot of that technological boost that we saw in the late 90s and early 2000s was not only because computers and the internet were able to work together, but also there was the civilianization of the infrastructure. Satellites could be used for global telecommunications and for, civilian GPS. It wasn't just all about positioning nuclear weapons. The internet was part of DARPA, back in the early days. That's where all that came from. So that was an example of these long-term trends coming together and merging. That's what we're in right now. And geopolitics and technology, the way they're forming up right now, I think it's very advantageous to the U.S. economy. So I want to be positioned and be invested in those companies. And I'm not just talking big tech companies. In fact, many of those, again, are overpriced. But it is that merging of technology and industry. That's where I think the best risk-adjusted growth opportunities are going to be. So it's not just about large language models, or it's just not about robotics or automation, but it's the industrial companies and the service companies that can take those technologies and create better products and services. When that technology is applied throughout the economy, and you're not just talking about moving around some electrons in a semiconductor, but you're talking about the physics of moving actual products and serving consumer needs. And so whether it's building infrastructure to transport the electricity that's going to power all that, or it's mining the ores and the copper and other elements out of the ground to support that infrastructure, or whether it's the consumer using apps and software to eventually buy and use products and services. It's that magnification and amplification of the technology that's going to be far more profitable than what we've seen up to this point. So I want to be invested in those types of good, solid companies that are going to take advantage and apply that technology. And while that might be longer term, right, we're not going to see all that fruit get harvested in 2025, but I want to be positioned in those now. And what I do think is going to come, especially early 2025, and this was whether Trump or Harris would have been elected president either way, because a lot of the early advantages and good potential for the stock market, it isn't about what Trump's policies are going to be or, even Trump himself. It's all about the absence of Biden. And I'm not being political here. I'm just stating the fact that over the last 4 years, the Biden administration has had draconian, overly restrictive, and relentless constriction and attacks on the business sector, whether it was the Federal Trade Commission, the Department of Justice, whatever type of antitrust policies they can put in place, they did. And they put up major roadblocks and restrictions to businesses. And again, this is not political. I don't have time to go into all the examples, but it wasn't just the tech companies. The tech companies get the headlines. There were so many examples of overly restrictive antitrust and unbusiness-friendly practices that occurred during the last 4 years that just getting rid of Biden is going to make the market an easier place to do business, and this was even if it would have been a Harris presidency. I mean, Harris was walking back a lot of Biden's antitrust and unbusiness-friendly policies. And I think it was no coincidence that, I mean, this is just one example, but I think it was no coincidence that the Washington Post, which is owned by Jeff Bezos, right, the guy that owns Amazon, the Washington Post chose not to endorse Harris for president. You know, over my lifetime, I can't think of, too many times when the Washington Post didn't endorse a Democrat for president. And it wasn't just the Washington Post. There was others. LA Times was another one. I think the business community, through their surrogates, were sending a message to Harris in particular and the Democratic Party overall that Biden went too far with unfriendly and antitrust business practices. And so all that's gone now. So again, that just in and of itself, I think is going to be a big spur to the first 6 months of 2025. I think you're going to see not only the realization, but at least a lot of talk of mergers and acquisitions that really drives excitement and enthusiasm on Wall Street, and it could definitely push a rally higher that would impact across the board, small, mid-size, and large cap companies. And again, this is something that didn't matter who was going to be president, but the repeal of the Chevron Doctrine by the Supreme Court last year. That Chevron Doctrine went into place in 1984 as rail guards and as a hindrance to the deregulation policies that then President Reagan was putting in place. And it's been used primarily against businesses and in favor of federal agency actions, things like the Environmental Protection Agency. Well, that's all been called into question now. And when you combine that with a more business-friendly environment that's going to happen absent Biden, then again, I think short term, that's extremely good for the stock market. And I'll end this episode on kind of an odd note, and I haven't heard anybody make mention of this, but while many in the bureaucracy and specifically the Democrat Party were very upset about the reversal of the Chevron Doctrine, now that Trump is president, watch how that's actually used against the executive branch. Because counterintuitively, the judicial system can cite the fact that the Chevron Doctrine has been reversed and that they don't have to give precedence to the interpretations of the administrative agency. And the administrative agency in this case happens to be a Trump administration, which they could potentially be hostile to. Well, now you can see that getting reversed where they can use the absence of the Chevron Doctrine to say that federal agencies don't have the right to release those same restrictions. It's convoluted, but it's fun to think about. Hey, in any case, we're getting close to the end of the year. I'm going to do my best to get another episode or two out. But just in case I don't, because, hey, we know how I am with consistency of podcast content. But in any case, if you don't hear from me between now and the end of the year, I want to end on this note. You know, I always talk about building wealth and mostly trading and things in the stock market because that's how I build my wealth. But remember, that's just my method. That's my means to wealth. Building wealth is an individual endeavor. And whether you're choosing to invest in stocks or the stock market or to own businesses or to build your own business or real estate or, even if you work at a nonprofit or your job is to just be, a stay-at-home mom or dad raising your kids, hey, you're doing the Lord's work there. And the whole purpose of building wealth is not for wealth creation itself, but it's for you as an individual to enhance your life and the lives and the people around you that you can have an impact on. So as I go into 2025 with optimism about the stock market and where I'm going to be making my investments, I'm equally optimistic about my own personal efforts, and I want to encourage you to be the same. I know there's a lot of gloom and doom in the headlines. There's negativity everywhere you want to see it. But that's just it. That's the trick. Don't see it. Don't look for it. Focus on the positive. Focus on the things that you can do in your life to enhance your wealth and take your God-given abilities and create products and services that make your life better and, more importantly, other people's lives better. There's an old saying from a guy named Earl Nightingale, And I remember the first time I heard this I was in my early to mid-30s. It was a real epiphany moment, and it crystallized how I would then structure my business practices and my wealth building. And what Earl Nightingale said that was so impactful to me was, to become rich, you must first enrich others. So again, whether you're building your own business or whether you're investing in companies or whether you're an employee or whether you're just a mom and dad trying to take care of your kids, come up with ways using your God-given talents and abilities to enrich those other people's lives. Create those products and services. Be a better dad, be a better mom, be a better husband, be a better wife, be a better employee, be a better business owner, whatever. But we have technology and freedoms and abilities today that none of our ancestors ever had access to. So make the most of it. There has literally never been a better time in the history of humanity to be alive. So until next time, as always, this is John Pugliano wishing you the very best returns.